welcome to Financial Planner. Now, if I had asked you a couple of years ago to open your dad's wallet and see what's inside, what would you have seen? For one, your dad's wallet would have had, I'm assuming, not just old bills, some crumpled paper perhaps, but also cash, paper money. Now take a look at your own wallet now, and I'm pretty sure that what you're seeing is less paper and more plastic. There are debit cards and credit cards and shopping discount cards. Most of us make or do with one or two debit cards, and then there are some of us that use credit cards more generously. Now on today's show, we'll discuss credit cards and find out if it's such a good thing after all. My name is Smriti Rao, and with me is Sumeet Vaid. Sumeet is a certified financial planner. Hi Sumeet. Now let's get started. It's such a big murky topic to get into, but we'll try and skim the surface and then try and get into some details. Now when we talk about credit cards, we often get mixed reactions from people. People think that's one way that you can bind yourself in debt forever, which is an aggressive, extreme sense of viewing a credit card. The other ways people look at it as, you know, it's a good thing to have in your wallet. What would you tell people about credit cards?
First of all, I'll react to your starting comment about the dad with a the wallet full of credit cards or purse.
Cash.
I presume that dad is an American dad and he is in a very sorry state because of those wretched credit cards. Forget about the dad, the country is in sorry state. Forget about that country, I think few continents are in very sorry state. So that's my starting point. That's the menace of credit card. That's the menace of easy money. That's the menace of easy money resulting in greed. We need to fundamentally understand there are two important paradigms or pillars of life: saving and investment.
Right.
All right. If we define in a very simple way what is saving, it's income minus expenses.
Right.
And when you save for long term, it becomes investment.
Right.
Now, if you are having a credit card, my basic presumption is there's no saving.
Because you look at it as an excuse to swipe your card, live off that intangible money. So you think that there's no saving.
That's right. Because a credit card is basically when you have income, but your expenses are more than income. So in order to bridge that gap, you need to have
a credit card.
That's right.
But some people also view it as, you know, I can have my credit card and I can use it for emergencies. I can use it when, you know, something happens and I need to have 50,000 ready cash. I can use that card, which is how some people view it. What would you tell those people, that there are other ways to do this apart from having plastic?
Definitely. First and foremost, for any family, worth its worth, should have a financial plan.
Right.
And once you do a financial plan, the first step of financial planning is emergency planning or contingency planning, in which each family goes through a situation of trying to determine what kind of emergencies they can go through and what is the bare minimum amount of money they need to put aside in a liquid asset. So if tomorrow that happens, I'm taken care of.
Right.
So that's the first step. If you have taken care of that, why do you need credit card?
Right. So what would you tell families then? Also, Sumeet, tell us a little bit about, the sort of people who come to you. And I'm sure that, over your rich experience as a financial planner, you had these people, these families come to you, they were racked up lots of debt and they don't know how to deal with it.
Actually, not only from a financial planning perspective, but generally with let's say finance or any such topic perspective, most of the families get fallen in two categories.
Right.
One are on the greed category. The other is on the fear category.
Greed and fear.
Yeah, greed and fear.
Tell us about the greed category.
So the greed category is, okay, I've got money, I need to make more, I need to have quick bucks. So we as the financial planners need to go and sit with them, try and explain to them there's no quick buck, there's no quick lunch. There's returns, and along with it there are risks. We need to quantify goals and help you in doing that.
Right.
Second is the fearful category. The fearful category is that I'm sitting on debt, which is like a time bomb. Try and escape me out of it. Otherwise I'm into a problem. I'm losing my sleep. So we go to them and work with them in a methodical manner over a period of time, first at psychological level, then actually at financial and discipline level, to try and take them out of debt over a period of time and then get them on the course which is the right direction. And increasingly we are seeing, in the age brackets of 30 to 35, or let's even go down, 28 to 35, youngsters just married, about to have kids or have one or two kids very young, they are getting into this debt trap.
Why is that? Why do you think younger kids have so much debt? Do you think it's just the feeling of recklessness, or do you think it's just financial imprudence that you have this card? And you know how easy it is to get these credit cards. As the companies call you up, they're more than willing to give you a card or two cards or three cards, depending on what your need is. And then you have all of these kids getting into debt. Talk to us about why these people see themselves with so much debt.
I think it's also to do with the generation. This is the generation which we are talking about, who haven't really seen any kind of challenge or struggles in their life.
Right.
I remember my dad talking about times when they had going very tough and saving money, and we listening to the same bit and drawing on from them. But I think this new generation which has come up have seen it an easy kind of a life. So they do not understand the importance of money. That's first. The second point which you made, which is very vital, is ease of getting a credit card.
Right.
So today, forget about one, you get 2, 3. Banks are competing with each other, and few banks have a criteria. If you have credit card of this bank, I'll give it for you free. If you have an MBA from this institute, I'll give it for free.
Right.
If you're a doctor from that institute, I'll give it for free. So it comes as a freebie, and before somebody explains you, you know, how to deal with this responsibly, you're already in debt.
Right.
You're already in debt, and it's a vicious circle. I know of clients who have come to us who've used one credit card to repay the debt of other earlier credit card, and it's a vicious circle.
People often think that credit cards are like a license to overspend, you know. What would you say about that? That I have this card, now I can spend, and like you said, use one card to pay off the debt of another card. What would you tell? How would you caution people about this against overspending?
I think first and foremost perspective which people need to understand is saving is an essential part at a family level,
right,
at a country level.
Right.
And that's what will really do well for you over a period of time. And if you can get that discipline going, I think you can manage credit card. Saving principle, as I mentioned earlier, income minus expenses. Now, some of your expenses you can use credit card to pay till the time expenses are less than income.
Right. Okay. So you can. So you're not completely against credit cards. What you're trying to say is you have to be judicious about the use of your credit cards. If someone does want to get a credit card, Sumeet, at this point, what would you tell them? How do you use it and not abuse your credit cards?
Okay, let's kind of refine that statement of yours. I'm not saying that I'm not against credit cards. I'm saying I'm not against cards, because cards can be a debit card. That's much more doable, you know, much more acceptable. Credit card somewhere still requires humongous amount of discipline and self-restraint, which you usually don't see, you know, people having it kind of a thing itself.
Right.
So I will still continue to say credit card is completely avoidable.
It's completely avoidable.
That's right.
There's, unlike in some other countries where you actually need a credit history, it's completely okay for people like you and me. We can make do with a debit card. But I want to make the point that, you know, for people who are still interested in getting credit cards, therefore we want to tell you, if you want to get a credit card, if you do have a credit card at this point, it's important that you know what you're getting yourself into. Number one, read the terms and conditions carefully, know what you're getting yourself into. The second thing is keep a reminder on your phone for payments. Sumeet, what would you tell people? I mean, you know, a lot of people already have those cards. How do you think that they should keep track of all their payments? Any ideas that you have in particular about this?
Yes, I have one only ideas to that. Slightly cliched, but I'll tell all those families to have a financial planner first of all.
To have a financial planner.
Yeah, because what that financial planner is going to do is try and keep you on a check.
Keep you on a check, okay.
And that's very, very important, because once your family financial plan is made and somebody is tracking it on a month-on-month basis, on a regular basis, you know where you're going off track. And if you go off track, somebody's there to help you to get on track.
Right.
Before you get into a vicious circle, you know, it's a very bad thing to get into.
Right, it's a very bad thing to get into, but like we said, we're trying to also give you some other ideas. One of them was, you know, keep tabs, get yourself a financial planner. The other thing is have a direct debit from your bank account. So if you do have to make those payments, it goes out a certain amount of money every month on a certain date, so you don't fall behind on your payments. And please pay the full amount immediately. You don't want to talk to us about those interest payments. We know that those can be deadly for people who have.
And that again brings us to one more point. And as soon as we say that pay the full amount before you do revolve to the next month, if you are getting into that habit, technically you don't need a credit card.
That's true.
Technically you don't. And coming back to the charges, it's like a big menace. You know, I think average charges for credit card rate should range from 2 to 3.5%, if I'm not wrong.
Right.
And let's even assume 2.5% over 12 months, you're paying more than 30% interest plus expenses. Many a case it becomes 40%. So what kind of expense are you incurring which is going to charge you at 40% rate of interest? I think that's completely criminal, not called for, and avoidable.
Okay, so that's avoidable. So Sumeet feeling very strongly about those credit cards. Now let's just slip into a short break right now. We've told you what you should do, whether you need a card or you don't need a card, and some ideas on how you should be dealing with those payments. But after this, we'll talk a little bit more about some bad credit habits and what you can do to avoid them. That's coming up in a bit.